All right, let's talk about VaR, or value at risk for market risk. So in the world of finance, there are few types of risk. So we have the types of risks that we can keep eye on, this kind of risk, and they are important. If you are applying for the credit, so maybe we have a kind of risk here, might arise from the credit, and we can call it the credit risk. And if we are doing a kind of operation in the financial institution and all the things that are happening there as the operations, they might make also some kind of risks. Okay, so this kind of risk are also important to be considered because all the operations that we have, all the IT systems, they might have some problems and some risks to lose the information of the customers, to have some fraud. So this kind of risk might also happen, that they are very important to be considered, especially based on the Basel Accord. So we have the operational risks also. The other type of risk that is important is something that nowadays also it makes a lot of problems for the financial systems. Okay, so they might fall down with what? With the liquidity risk, right? So the liquidity risk is also very important to have enough money on touching the balance sheet to deal with the problems that might arise. And some of them are expected, some of them are unexpected needs of money at a certain point in time. And if we don't have enough money to compensate with all of our loss in the market or the liabilities that we might have, then it might make a panic in the market, and the people might rush to the financial institution and ask for the money. That it will increase the problem with the problem, and the liquidity risk might make a big problem for the financial institution. But in the market, most of the time, what we have is what? A kind of opportunity that we might see in the market. Okay, so imagine that we are looking at the market and we can see something very interesting. Okay, so an opportunity in the market. So we might rush to the market to use the opportunity and go of that possibility to earn money and to have benefit from market. So we might see more opportunity in an investment for future. Even more, okay? And then finally, we might have a kind of risk here, okay? waiting for us. After a while, we can see that the good days of the market will not last forever. So we might have some danger here, okay? That we call it the risk, and in this case, we have it as market risk, right? So market risk is a big deal, especially after the 2008 financial crisis that caused a loss for $3.4 trillion worldwide. Okay, so after that, especially the financial crisis, 2008 with 3.4 trillion loss. Okay. It became more and more important for the regulators, for the financial market to take a look at the regulations, whatever they are applying in the balance sheet, in their programs, in their strategic plans, and keep eye on the market risk and monitor it more, because they could see the big effect of these kind of problems that might arise from the market risk, okay, as the systematic risk. So to understand the market risk better, folks will start with focusing on something called value at risk, okay? So the value at risk became more and more important, or the VaR, okay? So this is the way to measure the risk of unexpected changes. In what? In prices. Within a specific time, okay, as we said, the time here is also important, and also a confidence level with a within a confidence level. So the confidence level is also important here to be considered to calculate the value. So think of it as tool to figure out how much could go wrong in the market. So by the basic definition, the VaR is the maximum unexpected or potential loss on the portfolio. So from this, the unexpected changes in the prices, they will make kind of loss in the portfolio. So we can expect some potential loss, okay, and the maximum of that expected potential loss on the portfolio over the time. It will give us a measure that we call it the VaR, and this can be a measure for the market conditions, okay, to show us that what is the difference between the situation that we have with the situation that is for the normal market conditions. So if we want to summarize everything about VaR, that what are really important, we must remember always that the key elements describe the value at risk or the VaR is first a time period that we have to consider. Second, the dollar amount of value at risk would be for portfolio, assets, etc. And third, a given normal market condition that mathematically we call it confidence interval. Okay, so the confidence interval. So for example, if we consider the portfolio, okay, the portfolio of what? 100 million portfolio. We can consider a confidence interval of 95%. Then we have to consider the time period. So we can say for 1 month horizon. Typically, ESA wants to calculate the VaR for 1 month's horizon, 30 days. Okay. Days. And it is simple and popular way to measure the market risk. Companies find it super handy because it gives a quick summary of overall risk that they are facing. So VaR is something that is very popular in the market. And it's not just for the market risk. As we said, we have the credit risk, operational risk, liquidity risk, and also the market risk. So we can use the VaR to represent the different kind of risk and have the maximum loss expected from all of these kind of risks. So the VaR is not just for market risk, but it is one of the most popular way that we calculate the market risk. Okay. So if we want to say more, for example, for the financial system, if we consider bank, okay, imagine that we have a bank. Or a kind of financial institution. So the VaR is like what? Like a measure to manage all kinds of risk, and it can be useful. The big financial institutions like banks, the investment folks use it to estimate the maximum potential loss of their investment during a specific time. So investment banks, for example, during a specific time, they commonly apply the value at risk modeling to firm-wide risk due to the potential for independent trading tests. Why? Because this, they have the what? The independent trading tests, and they will apply this VaR to have a control on this independent trading test, unintentional expose the firms and the bank, the investment banks, to highly correlated assets. So that would be a big risk for the bank that they want to avoid it. And we can apply VaR to avoid this problem for the financial institution and for investment banks. But not only this, it is not just a tool that we can use it to manage the risk. It is also a regulation thing. Okay, so regulators use also VaR like a safety margin. So VaR could be also used as the safety margin to make sure things don't go on the right side under certain confidence levels, and also time frame that we said that they are important, with whom the authorities and regulators. So it could be used also with not only banks, but also with central banks. Okay. So if we want to represent the value at risk, we can consider the distribution of daily returns. Okay, so let's consider the Nasdaq 100. Okay, so we have the actual daily returns. Also, we can consider the normal distribution here. So the normal distribution like this, okay, so instead of actual returns, here we look at what? We look at the worst 5%. Okay, let's consider that this is the 5% of the normal curve, or maybe 1%. Okay. We usually consider it as alpha. So here we have what? We have the frequency. So let's consider it as 50, 100, 150, 200, 250, 300. So this is the frequency. So we might have 1,000 actual returns, and this might represent only a part. And here we have the time, as we said, that the time is also important to be considered, and the percentages that we have for the benefit and for the loss. Okay. So we have the daily returns here, the actual daily returns, and we have also these as the normal distribution. Okay. So what is important for us to look is not the actual returns. Here we look at the worst 5% or 1% in this graph. Okay. So a financial firm may determine an asset has a 3% one month's value at risk of, for example, 5% or 1%, representing a 3% change in the asset, okay? And changing in the value, change in the value by 5% or 1%. Okay, during a line, 1 month's time frame. So the conversion of the 3% chance of accuracy of a daily ratio places the odds of 2% loss at, for example, one day per month. So mathematical definition of value at risk. The VaR of a portfolio represent the maximum loss, right? So this is the maximum loss within a confidence level. So the confidence level should be also considered. The confidence level, let's consider it as 1 minus alpha. Okay, that is what? Between 0 and 1. So a number between 0 and 1 that the portfolio could incur over a specific time period. So the time period is also important. So we can consider the D days horizon. So all the items that we said they are important for calculating the VaR all considered here. And formally, we have what? We have distribution, as we could see, for the profit and loss. So consider this as the profit and loss distribution. Okay. And as we said, this part of distribution that we can consider it as alpha. It will represent the VaR. Okay. So we know that from here to here, the cumulative probability in the shaded area is equal to this alpha, right? And we have the time here, so we have the, as we said, the D-Day investment. So on this side, we have the profit, okay? So if it is alpha, the other side would be 1 minus alpha. So the confidence level for the other side, 1 minus alpha, and for this part, it would be alpha, right? So if the 10-day, for example, if we consider the 10-day 95% value at risk of a portfolio that is 10 million, okay, so for a portfolio then they expect that with 95% confidence, here we consider 95% of confidence, is that the portfolio will not lose more than how much? $10 million euros during any 10-day periods, okay? So we have this 10-day, and the value, it is 10 million euros, is that the portfolio will not lose more than this amount. Okay. So mathematically speaking, the 1 minus alpha value at risk by considering random x for the profit and loss can be defined as what? Can be defined as the VaR of this x by considering alpha that is important. Okay. So this VaR would be equal to minus what? X given fx, that is the CDF, is the cumulative distribution function, less than this alpha. That is what? This one. So how we can read it? It is saying that the value at risk for x is equal to minus, okay, so minus of what? X, that is what? This part, so this is the loss, so the minus the loss, okay, and we call it x. So this is the loss, this is the negative, and we have a negative sign here. So it will be positive, and finally the value that we will have for VaR would be also positive. Okay. So given that what? Given that this f given that a greater loss than x occurs in no more than a percentage of cases. This is the level of the confidence that we need to have, and we might try to make sure that the loss that we are going to make will not be greater than a certain point. Okay, so this is how we can represent it, and this is how we can write it mathematically. And we have a confidence level. This confidence level is important, the percentage of the cases that we want to consider for our calculation. So if we consider the confidence level, for example, the confidence level, right, for P, a number between 0 and 1, and assume the time index of t, so we have to also consider the time. So the time can be considered, the time index, as the t, and t plus something like alpha. We want to find what? We want to find the changes in the asset that we can represent it with the delta the value with an alpha that we consider it here, okay? So it is the financial position over the time period alpha. So if we have this condition, we can consider a cumulative distribution, or what we had here as the P&L distribution. So consider it as cumulative density function as a percentage. And as we had here increase in the probability, it would increase here till get an approximation to 1. And as we had here the VaR, here also we will have it as VaR, okay? The value at risk, and this is similar to this, the D-Day investment profit. So if we consider this function as the f alpha x, conditional to alpha, and also we have the random variable x with the value x, and it would be defined as the probability of the delta V alpha, okay, less than or equal to this x. So this is what the cumulative distribution function for the CDF of delta V alpha, right? So for this cumulative function that we have, we can say that the P that we consider here between 0 and 1, so this P would be equal to what? The probability of delta V alpha less than this VaR. Okay, so here, this is the P that we have, and it would be equal to what? This distribution, the cumulative density function of this VaR with the level of alpha if financial position is like delta V alpha is less than or equal to 0, we have this situation. And for line position, over time horizon alpha, for a given what? For a given P, okay? That we have it here. But for a holder of a short position, in a given time alpha. With probability P, again. And the financial position, consider that delta V of alpha is greater than or equal to 0. Not like the previous situation that was the less than or equal to 0. So the P that we had before would be equal to what? The probability of delta V alpha, this time greater than or equal to VaR. So that is on the other side of the distribution. And if we want to write it similar to this, we can write it as 1 minus whatever we had here. So if we call it as 1, okay, let me change the color, the pen, to see what we are talking about. So if we consider it as 1, it would be 1 minus this one, okay? At this time, it would be 1 minus F alpha of the value at risk. So now, as the challenge for you, the question and the assignment, give me your feedback about what you learned here. Consider that we have the P and L distribution. Okay, so we have the probability distribution similar to before, but now the tail is different. So this is what? This is the value at risk. Let's consider here as 0. So this is the probability distribution function as a percentage of investment X. So here we have the VaR. It is what? It is the cumulative probability in the shaded area. That is what? Alpha. And here, if we consider it as alpha, it would be 1 minus alpha. And this is what? This is the D-Day investment profit. And the normal situation that we had was similar to this, but this time we don't have that heavy tail. So here we have the value at risk here, everything similar to that part. So this is the alpha, this is the 0, so 1 minus alpha also here. So the question is what? Do they have the same value at risk? Okay. So if the answer is yes, why the profit and loss distribution for the second one that we can consider it is for investment X, we can consider it for investment Y. So why the profit and loss distribution of this one, of Y, is riskier with larger or smaller potential losses. So it is justified that if the investment Y has the larger or smaller potential losses in comparison with X, and why this one might be riskier investment. And finally, for this one, if you consider it as question 1, question 2, the question 3 might be related to the solution, right? So consider the SRS testing that we discussed in our classes. So the SRS testing might be a complement for the VaR, for the value at risk as a solution or not, to address this blind spot of the alpha tail that we have here, okay, of the distribution, as they are similar with the alpha and also the value at risk. So think about it if that's as the third question. SRS testing, if it could be a solution, okay? So these 3 challenges and questions based on what you learned. So try to analyze it based on the graphs and the P&L distribution function that you have, the cumulative function. So look at the VaR, the alpha, and the definition of and all the stress testing that might do for us, if it can be the kind of solution for this problem that the VaR cannot make a difference between these 2 investments. So for these 2, the VaR are similar, but maybe we can use the stress testing as a solution or the complement for the value at risk. And if we report these 2 together, then we don't have any problem like this that we can see in these graphs.